First big inflation breaking news of 2022, our December read on the Consumer Price Index, CPI. Headline number expected up 0.4, a little hotter, up 0.5, but that's definitely much cooler than the high water mark, which has been up 0.9. That was the highest in 13 years in October. And if we look at ex-food and energy, that was up 0.6. And currently, well, 0.6 isn't the high water mark. We have come down a bit. The high water mark was up 0.9. That was in April and June. Those were 40-year highs, so we have come down a bit. Now, here's the big numbers. Year over year, headline is up 7%. 7%. That is the highest since 1982, June to be specific, when it was up 7.1. And if we look at year over year core, of course, that's not with including food and energy, it's up 5.5%. To find a higher number than 5.5%, we go all the way back to Valentine's Day of 1991, where it was up 5.6%. We'll call that 30 years. So these are definitely hotter than expected numbers. And, of course, we probably should have expected this. And when you consider what inflation's done, and you think, wow, we're at 7%, 5.5% on core, and there's the 10-year note yield, what, around 1 3/4. Very interesting, because as you look at real average weekly earnings year over year, they're down 2.3%. And if you look at the real hourly earnings year over year, they're down 2.4%. So, of course, we always talk about various issues such as wages and how inflation is helping some by boosting up labor costs to companies. That's the inflation we're experiencing. It certainly isn't being applied equally, meaning inflation is moving much faster than wages, and when it moves back down, wages are going to be awfully sticky, and that's probably what we should be concentrating on the most. Andrew, back to you.
Rick, very, very smart analysis this morning on this. We want to get some more on the data and the Fed's ability to fight inflation. We want to bring in Nela Richardson, chief economist at ADP. Good morning to you. You look at these numbers. If you're Jay Powell, what do you do? I think he was referencing maybe some expectation that this was going to be the case even yesterday.
I think you lean into your pivot. I think you lean into the fact that inflation is going to be with us longer than expected. It's not transitory. They put that word to bed. It is actually present, and that they have to proceed with the plan that's been articulated, which is to roll down some of that Fed purchasing, remove the accommodation, and start raising interest rates to control inflation. Right now, I think the Fed is a little hesitant to rip off the Band-Aid. They've approached this pretty gently, but inflation's not gentle. It's a sledgehammer, and we're seeing that play out in the numbers.
We don't need to relitigate history, but we will for just a moment. Have they already made a policy mistake?
They've made unprecedented policy changes. And so history, I think, is still being written on whether those changes were a mistake. Let's go back a couple of years now to average inflation targeting, allowing inflation to rise above that 2% target and being comfortable, even as inflation started picking up, being a bit gentle again with the transitory nature of the inflation, not trying to calm the markets in terms of accepting higher inflation rates, and now having to do a lot of things at once, roll off the balance, roll down the Fed purchases every month, and start raising interest rates. So policy mistakes in an unprecedented time take a little bit more room and distance to judge, but they are in the thick of it, that's for sure. And the way forward is for them to take decisive action on inflation now.